Over the past 2 years, Singapore's equity market has been a strong performer. The STI index continues to hit new highs, supported in part by the Monetary Authority of Singapore's 5 billion Equity Market Development Programme, or EQDP. As of November 2025, nearly 4 billion of this program has already been deployed. But the big question investors are asking is this: how sustainable is the rally beyond the EQDP stimulus? To answer that, we need to understand how the Singapore market actually works. First, in markets globally, liquidity for small and mid-cap stocks is mainly driven by domestic investors. Second, small and mid-caps typically benefit when large-cap stocks perform well. Why? Because when investors take profit from large caps, they often rotate into small and mid-caps as a laggard play, creating a liquidity waterfall. Third, the EQDP program adds an additional injection of liquidity that can help strengthen valuations in the small and mid-cap space. And finally, higher valuations attract more companies to list on the Singapore Exchange, from IPOs to dual listings to follow-on placements, creating a virtuous cycle of market activity. Here's a key insight. From end 2024 to end 2025, the STI index's market cap grew from 870 billion to 1.1 trillion, an increase of over 200 billion. This potential source of liquidity far outweighs the $5 billion EQDP program. In other words, the long-term sustainability of the small and mid-cap valuations depend heavily on whether the STI itself continues to perform strongly. So, can the STI index keep up its momentum? A key driver has been the financial sector, supported by Singapore's rise as a global safe haven. Assets under management continue to grow among Singapore's major banks, contributing directly to earnings and supporting market valuations. With global geopolitical uncertainty not fading anytime soon, Singapore's safe haven status is likely to remain a long-term tailwind for the STI index and a crucial liquidity source for small and mid-caps. Beyond financials, Singapore can leverage on its neutrality to build a new growth platform. Sectors like aviation, energy and marine, and telecommunications already rely on Singapore's geopolitical positioning to drive cross-border business-to-government engagements. Looking ahead, new frontier technologies, artificial intelligence, biotechnology, and other geopolitically contested technology areas represent opportunities where Singapore can act as a trusted export hub. As companies across Asia seek a stable base for global expansion, more of them may choose to establish headquarters in Singapore and list on the Singapore Exchange. This expands the set of growth thematics that can drive the next phase of market re-rating. So, while investor attention has been fixed on the EQDP program, it's important to recognize the bigger picture. The STI index is already benefiting from a structural, long-term tailwinds tied with global uncertainty, tailwinds that may last well beyond 2026. For investors, the opportunity lies in recognizing this shift, a rotation from global equity allocations dominated by US equities towards Singapore equities backed by a compelling safe haven story. This is what could drive a sustained re-rating of the Singapore small and mid-cap sector. Singapore isn't just rebounding, it's redefining its role in the global investment landscape. To find out more, please go to our website for our 2026 Singapore Market Outlook. Thank you.